Inflation refers to a general increase in the prices of goods and services in an economy over a period of time. When the cost of living increases and the purchasing power of money decreases, it's said to be inflation. Inflation can impact the stock market in a few ways. Higher interest rates. If inflation rises, central banks may raise interest rates to curb it, which can lead to a decrease in consumer and business spending, ultimately affecting corporate profits and stock prices. Decreased consumer spending. When inflation rises, people's purchasing power decreases, which can lead to a decrease in consumer spending and a slowdown in economic growth. This can negatively impact corporate earnings and stock prices. Currency devaluation. Inflation can lead to a devaluation of a country's currency, making imports more expensive and potentially affecting international trade. However, it's important to note that there can also be positive effects of inflation on the stock market. For example, if inflation is a result of increased economic growth, it can lead to higher corporate earnings and ultimately, higher stock prices. Overall, inflation is one of many factors that can impact the stock market, and its effects can be both positive and negative. Does printing more money cause inflation? Printing more money can lead to inflation if the amount of money in circulation exceeds the growth of the underlying economy, which can lead to a decrease in the purchasing power of money. Printing more money increases the money supply, which can lead to a decrease in the value of each unit of currency, causing prices of goods and services to rise. This is known as inflation. How is inflation measured? Inflation is typically measured using an index, such as the Consumer Price Index, CPI, or the Producer Price Index, PPI. The CPI measures the average change in prices paid by consumers for a basket of goods and services, while the PPI measures the average change in prices received by producers for their goods and services. To determine inflation, government agencies typically collect data on prices for a fixed basket of goods and services at regular intervals. The change in the overall price level is then calculated and used to determine the inflation rate. In addition to indices, economists may also use other measures, such as the gross domestic product, GDP, deflator, to determine inflation. It is important to note that different measures of inflation may produce different results, and that inflation can also be affected by factors such as changes in the quality of goods and services, as well as measurement errors.